Hello, everybody. It's Ted Bauman here. Now, as I said in my first video, one of the things I'm interested in is the collapse of the crypto exchange known as FTX. And today I want to talk about that. And the real question that people are asking themselves is how does a $32 billion company like FTX just vaporize overnight? Well, the short answer is that it was never worth $32 billion in the first place. People just believed it was with a big helping hand from this guy right here, Sam Bankman-Fried. Now, here's Sam with two very famous people. That's Tony Blair and Bill Clinton. The bottom line here is that this guy went on a mission to convince people that he was the most legitimate player in the crypto space, that he was the only one who could really be trusted, and that his company and others like it were the place to put your money if you were in crypto. Now, what was FTX? FTX was a crypto exchange. Now, crypto exchanges exist for one simple reason, and that's because current blockchain technology isn't robust enough to allow people to trade in a truly decentralized manner. Now, I know there are plenty of decentralized protocols, and in fact, FTX had one, but the bottom line is that in order for crypto trading to take place at scale, you need somebody to be a market maker, and that's what FTX was. It provides liquidity to crypto markets. It sells tokens and buys them from retail traders so they don't have to do it themselves because of all the difficulties involved with blockchain applications, and it makes money on trading fees. Now, in addition to facilitating trade in cryptocurrencies, FTX also stored them on customers' behalf. Most FTX customers didn't have their own crypto wallets. Instead, FTX maintained its own wallets and allocated crypto to its customers from within them. So when you bought crypto on FTX, you didn't get a wallet that allowed you to directly control it. FTX kept it on their wallets on your behalf. So in that sense, FTX was like a depository institution, i.e. a bank. And as you'll see, that's a very important part of the story. Now, FTX also allowed customers to trade on margin. They could borrow against tokens they had on deposit with FTX, and FTX made money from the interest they charged on these margin accounts. Now, the third big thing that FTX was involved in was issuing tokens of its own, including two, one called FTT and the other one SRM as part of the Serum protocol. Now, FTT was like a dividend yielding equity in FTX. People who held FTT would get a yield based on their share in FTX's profits. So that's important. It functioned effectively like a form of equity in FTX itself. Serum, on the other hand, is the token for an automated decentralized exchange system set up by FTX. You can think of Serum as being the decentralized version of FTX, so that if you really wanted to trade in a decentralized way, you could do it on the Serum system. Now, SBF, Sam Bankman-Fried, also created an investment fund that trades cryptocurrencies called Alameda Research. Now, Alameda made leverage bets on crypto tokens as well as investments in other crypto hedge funds, lending platforms, and other similar crypto activity. Now, Alameda was also a customer of FTX. In fact, Alameda ran up multi-billion-dollar margin positions on FTX in its FTX accounts. Some of these were long positions on tokens they thought would appreciate. Others were the result of bailouts of smaller crypto companies, deal that FBF had made in order to present himself as a hero and savior in the crypto sector. Now, FTX and Alameda were supposed to be separate, but SBF and his friends operated them effectively as one big pile of assets. There were practically no firewalls at all between the two businesses, and record keeping was apparently shambolic. In fact, worse than shambolic, it was criminal from the perspective of any normal business operation. Now, the most questionable aspect of the two companies' operations was their use of their own FTT and Serum tokens. 97% of those two tokens are held by crypto firms. 2/3 of that 90% is held by FTX and Alameda. That means that there's only about 3% of those tokens trading on the open market. Now, the current market price of a token like FTT or SRM is determined by trading between people who own that 3% of tokens. That's what's known as a highly illiquid market. when only a small proportion of the actual value of the asset, the numbers of the asset are trading on the open market, that's a very, very illiquid market. Now, FTX and Alameda recorded the value of their holdings of FTT and SRM as being the number of tokens they held multiplied by its current market price, trading in this highly illiquid market. FTX and Alameda based their business value, part of that $32 billion, including collateral sums deposited by Alameda against their own margin account at FTX, on this market price. Now, based on this method of valuation, Alameda deposited FTX and SRM tokens into its margin accounts at FTX and then borrowed against them to make huge bets in the crypto sector. The problem was that as the market value of FTT and SRM began to slide over the summer, Alameda's market position, its margin position on FTX, became untenable. Also, Alameda had taken out loans against FTT on the open market and used the money to make venture capital investments, like buying collapsing crypto trading houses earlier in the year. Now, when the crypto market started crashing in the late spring, early summer, lenders to Alameda moved to recall some of these loans. Now, at that point, on FTX's balance sheet, 14.4 billion was listed in FTX associated tokens like FTT and SRM. Only about $5.2 billion of its assets against $8.9 billion of liabilities to its customers was in normal financial stuff. But that normal financial stuff was highly illiquid. So basically, when lenders started calling up Sam Bankman-Fried and saying, hey, dude, we want our money back because things are not looking good, he couldn't give it to them. So to deal with that, FTX gave about $10 billion worth of its customers' accounts, in other words, the crypto that it was supposed to be holding on behalf of its customers, to Alameda so it could pay its debts. In return, Alameda gave it more collateral in the form of FTT in SRM. Now, throughout this entire process, Alameda and FTX continued to base their balance sheet position, in other words, what they told everybody their company was worth, on the value of FTT and Serum. The problem is that as the market deteriorated, other institutional holders of FTT, like Binance, for example, announced that they were going to liquidate their FTT holdings. That led to a run on the token. People started selling it, and that led to a collapse in its price, which, of course, also led to a collapse in FTX and Alameda's balance sheets. Now, it was at this point that FTX collapsed and was forced to file for bankruptcy. Now, before that bankruptcy filing, SBF tried to convince investors that FTX and Alameda had assets of sufficient value that they didn't have to declare bankruptcy. But what they weren't clear about was that the assets were those issued by FTX itself, FTX or FTT and SRM tokens. Now, just to stand back for a second and ask yourself, what logic is there behind this? Well, the immediate problem is that there's no way that FTX and Alameda could ever liquidate their holdings of these self-issued tokens, because that would flood the market and cause their price to crash, supply versus demand. And given that their value was supposed to be based on a future stream of revenues from FTX, the price was already collapsing as people began to lose confidence in FTX. Now, it's against the principles of banking, very much so, to accept stock in your own company as collateral for anything. Now, this is essentially what FTX and Alameda were doing. They issued FTT and Serum tokens as a form of, if you like, dividend yielding equity in their own operations. And they use that as collateral against their own lending operations. Imagine you went to a bank, asked for a loan, and offered the bank's own stock as collateral. They'd look at you and say, are you insane? That's because the value of the bank's stock is determined by the success of its business operations, which in turn depends on the health of its loan book, just like the loan you're asking for. Accepting your own stock as collateral would mean that if your loan went bad, the collateral that was supposed to back it would also decline in value, which would cause a death spiral and ruin the bank. So it was at this point, when people began to realize that this is what SBF and his companies had been doing, that the rest of the crypto sector realized this is a game that SBF had been playing. In fact, SBF had sketched out this scheme in an interview on Bloomberg on April 25th this year. Very, very famous. Go ahead and look at it. It's with the incomparable Matt Levine. If you don't read Matt Levine on Bloomberg, you're missing. He's one of the greatest. Anyway, essentially what SBF said was you first build a token, then you keep the percentage of tokens trading on the retail market low. You keep the liquidity low and you keep most of them. That low liquidity leads to a higher market price for the token and therefore a higher market cap for the token as a whole, like FTT and Serum. Now that the token you've created has a big market cap, you borrow against it. You borrow dollars and other hard assets against it by using it as collateral. So as long as nobody starts investigating the nature of your collateral assets, this scheme can work. So to make sure people don't start asking those kind of questions, do everything you can to instill confidence in your business and yourself. And that's exactly what FBF did. Dozens of investors who should have known better bought into FTX because of SBF's public relations campaign. And we're not talking small people. We're talking big groups like BlackRock and so on. Big houses spent big money on this scheme. Now, the problem here is not crypto itself. Satoshi Nakamoto set out the case for a decentralized, trustless blockchain where everyone held their own account and transactions were verified by anyone who wanted to take part. The problem with this, and the problem with Bitcoin in particular, was that transactions are slow, expensive, and hard to scale up. So as crypto has boomed, instead of following the path laid out by Nakamoto, the crypto boom has led to customers trading and holding crypto on exchanges like FTX, avoiding the need to interact directly with the blockchain. What that means, in effect, folks, is that the reliance on trust that Nakamoto was trying to avoid has been replicated through the emergence of these exchanges. The very thing that crypto was meant to avoid has become central to the crypto market. And as one of the biggest lessons of financial history is that when there's a need for trust, there are also dire consequences when that trust breaks down. SBF understood this. That's why he invested so much energy into building up a persona as the friendly face of crypto. That was how he tried to protect his own operation. The collapse of FTX illustrates what happens when that trust evaporates. The need to rely on trust, of course, is precisely what crypto promised to overcome. And here we are back at square one. Next week, I'll talk about some of the more detailed aspects of this, but particularly what it implies for crypto going forward. And again, I think it's important to recognize that essentially what crypto has done through the use of exchanges like FTX is recreate the very financial system that it was meant to overcome. Ted Bauman signing off. I'll talk to you next week.